Hello, everyone, and thank you for joining our session today with Lease Query to introduce the federal leasing standard SFFAS 54. My name is Ward Hewish. I'm a managing director with Cherry Bekaert and lead our federal government sector advisory group. With the federal leasing standard implementation date rapidly approaching, we're going to introduce the standard 54, review the phases of implementation, highlight how a software solution can help collect the required information, and share best practices and tips from others who are implementing the leasing standard. We will also have time in the end to answer questions that you may have today. Here are some items to note before we get started. So to receive CPE, CPE credit, you must answer at least 3 polling questions and attend for the full 50 minutes. CPE certificates will be issued via email within 10 days. If you've not received yours after 10 days, please email cbhlearning@cbh.com. A recorded version of this webinar will be available in about 1 week and will be sent out via email and posted to our website. If you have any questions during the webinar, please type them into the Q&A window located in your control panel. And just to note, a short survey will be posted at the conclusion of the webinar. We value your feedback and ask that you take part. Now that the CPE items are covered, I'm pleased to introduce our 2 knowledgeable speakers, Danny Martinez and Jason Parker. Danny is a director with Cherry Bekaert and is the accounting advisory lead for our government and public sector practice. As a CPA and certified government financial manager, Danny brings 15 years of audit experience, as well as he's being versed in GASB accounting, grants management, single audit, peer review, and GASB 87. Jason is a senior alliance manager at Lease Query and formerly Lease Query's lead solution consultant. Jason is an active CPA in the state of Georgia, and prior to joining Lease Query, Jason spent several years at KPMG in the external audit practice, serving both public and private clients in a wide range of verticals. For today's agenda, Danny will introduce Standard 54 and talk to us about understanding the phases of implementation. Jason will address gathering required lease information. Then both Danny and Jason will share lessons learned from GASB and FASB implementations. Before I hand it off to Danny, I'd like to have our first polling question. So what is your primary purpose for attending today's webinar? So the 4 selections or 5 selections there, interesting topic, need to implement the standard, knowledgeable presenters, or the knowledge of the presenters, CPE credit, or another reason. And as you're mulling that over, I'd like to let you know that there is a new article that Danny has written on the Lease Accounting Standard that is at our Cherry Bekaert website. So looking to see the rest of the polling questions here. And results. About 1/3 need to implement, 1/3 need CPA credit, because we know the end of the year is right around the corner. And then equal on knowledgeable partner presenters and interesting topic. Terrific. So at this point, I would like to turn it over to Danny. Danny.
Great, thank you, Ward, and thank you for everyone attending today. Let me just move on over to the introduction slide. There we go. I appreciate you all attending today, whether you are attending live or you have stumbled upon our website and are finding this as the archived version. As Ward covered, we're going to be doing a few things today, but not everything related to Statement 54. The way that we've built out this presentation is very similar to a kickoff call that we would be having with our advisory group, where we're going to give you just enough information about Statement 54 so you know what we're dealing with and what you all are going to be dealing with as you work towards implementation. And secondly, we're going to dig into the different phases of implementation and how you're going to progress from where you are today, just starting to learn about Statement 54, all the way down the road to where you're getting your required financial statement, journal entries, and disclosures. So again, thank you so much for attending. So what are we talking about today? So Statement 54 leases is effective for reporting periods beginning after September 30, 2023. So really, we're looking at fiscal year 24. And what is Statement 54 doing? What it is doing is it is putting a large number of your leasing transactions on the balance sheet when previously they may have just been disclosed in the notes. So we're getting rid of this idea of an operating lease or a capital lease and going to a single lease framework. This standard is very similar to the GASB standard, followed by state and local governments, in that you are addressing it both from the lessee perspective and the lessor perspective. One thing to note is that early adoption is not permitted for Statement 54, but that does not mean that you should wait until the period of implementation to start dealing with this and to start thinking about how you're going to handle implementation. Implementation is going to be handled on a prospective basis as of the adoption dates. So you're not going to have to go back and restate any revenues or expenses that were reported in prior periods, but you will be going through your leasing agreements that were in place at the beginning of that period of implementation and identifying what you have left as far as leasing or financing as of that date. And so one of the things that we've seen with implementation of the other standards is being able to identify all of the leasing transactions, all of those original contracts going back to whenever it was, whenever you originally signed the agreement, can take some time. So while it is prospective implementation, if you have an agreement that is still in place that meets the definition of a lease that we'll get into here in a minute, you're still going to have to be digging up some of those old contracts or agreements in some cases, even if they were entered into prior to fiscal year 24. This is one of the most significant changes to federal accounting standards. And as you know, initially it was going to be required to be implemented earlier. There's been quite a delay related to the COVID-19 pandemic, but we're as Ward said, it is now rapidly approaching. One of the things that I like to do whenever I meet with clients and start to discuss the leasing standard and help them to wrap their mind around what is a lease under the standard is to really let's just dig into the definition. Let's go straight to Statement 54 and let's pick apart each of the pieces of this definition and talk about what they mean. So here you can see the definition of a lease, and I'm going to go ahead and read it. So a lease is defined as a contract or agreement whereby one entity conveys the right to control the use of PP&E to another entity for a period of time as specified in the contract or agreement in exchange for consideration. And the FASB and GASB have their own definition of a lease, and here in Statement 54, we're kind of pulling parts of those lease definitions to be able to build the definition that works best and makes the most sense for federal governments. In here, you can see the green highlighted and bolded words. And so now let's go ahead and dig in and look at each piece of this definition. The first thing you want to note is that it is a contract or agreement. So within there, what you're thinking about is their legal enforceability. This definition also does not just specify contracts, but it also specifies agreements, because intragovernmental leases are often referred to as lease agreements, and FASAB wanted to make sure that there wasn't any ambiguity in terms of did these intergovernmental leases fall within the scope. And what you'll see as we talk about the definition later is that they do, even though they are maybe treated a little bit differently. The other thing to note here is that you're going to want to comb through all of your agreements. Just because it doesn't say lease agreement or lease contract in big bold letters at the top does not mean that, okay, now I can just pass that to the side and not think about it as far as implementation. We're really looking at that definition of, is there an asset that you all are leasing, regardless of what the terminology is on the header of that contract. The next thing that you're going to want to think about is the right to control. And so this would be a great time to point out the technical release 20. And what that is an implementation questions put out by FASAB that go through 99 questions of, hey, I have this scenario. Is this a lease? Or is this a lease term in this scenario? Or what is my cancellation? So they dig through 99 question and answers, and they give you a little bit of a roadmap as far as implementation. The reason I bring that up now is because this idea of control is one that is addressed in quite a few of those questions, really trying to determine, do I meet these two criteria here, A and B? So A is the right to obtain the economic benefits or services from use of the underlying asset as specified in the contractor agreement. And B is the right to control access to the economic benefits or services of the underlying asset. So we're looking at the obtaining economic benefits and as well as controlling the access. Given that framework, there's going to be a whole spectrum of items and areas related to control that you're really going to need to think about. Okay, in this scenario, do I have control? And like I said earlier, that technical release does provide you some clarity for some scenarios that you may run into. Next is period of time. So what that means is not indefinite. If you think back to what we're trying to do here as far as leases being financing, we're trying to get this leased asset or this lease liability on the books. And how do you put that on the books for a period of time if you don't have it, right? If it's just an indefinite lease, how do you determine the length of that contract? So what we're looking here is, what is the period of time that I have committed to leasing this property, plant, and equipment as specified in the contract? And so as we dig into future webinars, future articles, we'll really dig in deeper into the idea of the lease term and the lease payment as specified in the contract, as well as these options to extend or terminate. At this point, when you're in the learning phase and the accumulation of leases phase, the specifics within the agreement may not be as important to you, but let's dig into very quickly each of these. First, the lease term. We touched on it a little bit on the previous slide. How long have you committed to using this asset? The lease payment. How much have you committed to pay? Are you paying it annually, quarterly, monthly, and for how long have you committed? And what we're looking here is for the amount that is either fixed or fixed in substance. You may have some lease agreements where I agree I'm going to pay $10,000 a month, but there's also a variable component based off of performance or usage of that property, plant, and equipment. And what we're doing here as far as booking the asset and the lease liability is we're really looking for that fixed or fixed in substance portion. Now, there is so many forks in the road here as far as determining whether it meets the definition of fixed or fixed in substance, or if is it a variable payment. And those are things that you will want to dig into in the future to make sure you determine the right amount to record as your lease asset or lease liability. In addition, we're going to be looking at optionality. And so we're looking in your agreements, do you have an option to extend or an option to terminate? And if you do have one of those options to extend or terminate, are they reasonably probable, are they probable of being exercised? And so probable in the accounting literature for federal governments means more likely than not. So 50% and a feather likely to either extend or to terminate those agreements. If you are in this, say, for example, probable to extend an arrangement for one of those options, you would include that in that instance in the lease term. So really thinking about how likely it is that you're going to extend or terminate is going to be one of the more subjective things related to implementation of this accounting standard. And so you'll be looking at things like, am I getting a good deal? Do I need this building, this specific building, specific location, specific piece of equipment to operate this federal program that I'm operating? So there are things within the standard that help you determine where you land on that probability scale and determine whether you would include that option to extend or terminate in the lease contract. One other thing that's interesting here that people are realizing as they go through implementation is, oh, wow, I didn't know that I could get out of this lease in 60 days, or my lessor could get out of this lease within 90 days notice. And so as you go through implementation, it's been really interesting for people to actually find out what they have contracted and committed to, and that's just part of a byproduct of this journey that you're on with lease implementation. In exchange for consideration means, did the entity receive something in return? So this could be monetary or non-monetary. So in-kind services could also fall into this in exchange for consideration. Why is this important? Because with the low threshold of in exchange for consideration, you could have a large number of leases that meet this in exchange for consideration threshold that maybe are not at fair value, right? Or not a market transaction. And so when you're trying to identify the lease asset or the lease liability that you're putting on the books, it's going to be important to consider what materiality threshold you're going to utilize for implementation. And so just like all other accounting standards, you need not apply them to immaterial items, right? But you're going to have to go through this exercise of capturing the entire population to really figure out where that materiality threshold is, not only on an individual lease basis, but in the aggregate. Where are you drawing that line? Some definitions of note, I'm really going to hit hardest on the first two. Short-term leases. So short-term leases are excluded from the balance sheet presentation within Statement 54. So if you have a lease that as of the implementation date is a term of 24 months or less, so that's the maximum possible term, it would be considered a short-term lease. And so you would still record the revenue and the expense related to the transaction, but you wouldn't be putting anything on the balance sheet for that. This second bullet point is probably one that's going to excite a lot of you all: intragovernmental leases. So if you have a contract or agreement occurring between two or more consolidation entities, as defined by Statement 47, you would still need to include those as part of your implementation, but you get to exclude those from balance sheet presentation. So you're going to be recording a revenue and expense for the transactions that occur during the year, and you have a note disclosure that will be required as well. As FASAB was looking at the costs and benefits of implementing the standard and potential challenges, this was one area that was identified as a major challenge that they needed to address, and the way that they've addressed it are in paragraphs 26 through 38 of the standard, which talk about not having to put these on the balance sheet if they meet this definition. The rest of these we've included, and really the reason that we included these is there's specific definitions that help you calculate your lease liability. So as you're going through the compilation of your leases, these are things you want to note if you do have within your agreements. If you have some lease incentives, you'll want to make sure that you note those. Some lease concessions, such as rent holidays, free rent periods, reduced rents, leasehold improvements, lessor improvements, or initial direct lease costs. We will include the PowerPoint presentation, the PDF of this for you all, so you can refer back to these definitions. You can also find them just directly from the statement. So that is where I'm going to stop, just giving you enough to give you an idea of, okay, that is what a lease is under statement 54. At this point, I'm going to go into our next polling question. So given this definition of a lease that we just presented, how many leases do you estimate that your organization has? 0 to 25, 26 to 100, 101 to 500, or 500 plus, or I have no idea. Keeping in mind, this is both on the lessee side and on the lessor side. So if you all are operating as a landlord within your department or agency, and as well as those where you are financing property, plant, and equipment through a lease. Give you all a few more seconds to answer. I respect the honesty of the no idea, and that is why we are presenting this to you all today, to give you all a clearer idea to go back to your agencies and departments and start to be thinking about where you land within your agency. Perfect. All right, I have one more section that I am going to touch on. If you just give me 1 second to move the slide over. So the next thing that I'm going to touch on before I turn it over to Jason is understanding the phases of implementation. And so as Ward mentioned when he introduced me, I'm the government and public sector accounting advisory leader. And a lot of what we've been doing currently is leases implementation. Now that being said, most of it right now is the state and local version of GASB 87. But thankfully, this statement 54 takes a lot of what was utilized in GASB 87 and tweaks it for statement 54. So a lot of these things still apply, and really the overarching framework of how we implement, utilizing these 4 phases of implementation that I show you, these are going to be exactly the same. And so here it is. Here's our 4 phases of implementation. This is also the article that we wrote, so you all can think about how you should go about implementation and how you would be going about implementation should you all utilize assistance from Cherry Bekaert and Lease Query. The first phase is gaining an understanding of the statement and identifying key stakeholders. Second phase is identifying the complete lease population. Third phase, developing policies and procedures and identifying systems. And the fourth phase is reporting, disclosure, and go forward. And so what we're doing today is really hitting 1 and 2, right? We want to leave you all feeling much better about phases 1 and 2. And if those of you all that know me know I could talk probably for an hour just on these 4 phases, but I'll spare you all the time for now. We definitely will have additional webinars on this subject where we dig in a little bit deeper just to the phases, just to Q&As. But let's talk here briefly about the different phases. The first thing you need to do in phase 1 is what you're doing here today as you're watching this webinar, obtaining training on statement 54. I had a friend, a partner at an old firm who liked to put together his to-do list, and at the top of his to-do list was create to-do lists. And so he had it just so he could check off something every time that he started his to-do list. And really, that's what you all are doing here. You are not at ground zero anymore. You are checking off the first step of this to-do list, which is obtaining training. Secondly, you want to meet within the organization, your agency or department, and determine lease exposure. Where are our leases? You may have some good documentation around your capital leases. Maybe some of your operating leases you feel a little bit gray on, but this really is going to be an agency-wide or a department-wide effort. If you think about who can enter into this transaction, you're going to want to have a representative from each of those departments that have that ability at the table as you do step 3 in designing an implementation team to lead the organization. And I want to read something. This was a memo that went out a couple of years ago from Department of Defense, and I think it just does paints a better picture, does a better job at what you all should be doing and thinking about in terms of communication about this within your organization. And so it says implementation of the new framework will require substantial effort in engagement and training of cross-functional implementation teams, significantly improved internal controls and systems to support establishing and maintaining a complete universe of leases and related data, extensive data capture, consideration of materiality, including potential effects of the appropriate lease asset, and capitalization recognition thresholds, disclosure, and documentation. So they really do a good job there of saying, hey, this is a big deal. It's going to require everybody. It's going to require internal control modification. It's going to require systems. We need to be thinking about this now. And so if you have not communicated something like that to your organization, we have templates and things that you all can utilize to help get the message across that this is a big deal and you want to be dealing with this now. Phase 2 is the portion of implementation that is the most variable in terms of time. When people ask me, how long does it take to implement the leases standard, what I say is, how long do you think it's going to take for you to feel comfortable that you found all of your leases? And so you want to start with compiling the known leases within your agency. You want to utilize some checklists and some guidance to share to your departments or to your agencies. Anyone that can that has the ability to enter into a leasing transaction, this is what we're talking about. And so what we try to do is we try to take it from the finance and accounting language within the statement and put it into language that those who are more handling the day-to-day could understand. Have you entered into a transaction that could last for more than 24 months in one day? And is there a chance that we are not just straight out purchasing the thing? And does it relate to, property, plant, or equipment, something that you can lift up, something tangible that you can touch? Okay, we need to know about it. Maybe it's not within the scope of Statement 54 after you do that, but we want to at least know about it so we can cast that wide net. As you can guess, the biggest risk with biggest audit risk with implementation is completeness. And so casting that wide net is going to be very, very important as you implement Statement 54. Searching for embedded leases. So the federal standard doesn't specifically call them embedded leases. It doesn't use that word, but really what that word means is a lease that has, or a contract that has both a leasing component, so the ability to use property, plant, and equipment, along with maybe some service component. A few examples that you can think about is maybe you all are utilizing, let's say a building. So you're renting a building. So that is a leased property, plant, and equipment, but you're also getting maybe some janitorial services or some maintenance services associated with it. See it sometimes in copiers, right? You have a lease for copy machines, but you also are paying a certain portion for maintenance or for say maybe ink, or things like that. So one of the bigger challenges is identifying all of those embedded leases, and there's a lot of good material and content out there around helping you all to identify those. The other thing that we recommend is using some data analytics or other methods to scan your general ledger for potential leasing transactions. Where this is helpful is, okay, where you normally record your lease activity. It's in this one expense GL code, but let's run it through these other ones and let's see if it's pulling out things that sound like a lease. So what you're looking for, is it 12 equal or almost equal payments? Is it have a vendor name that maybe sounds like someone that you might lease from? Depending on how good you all are at GL descriptions, is there a GL description that sounds like something that could be property, plant, or equipment? So those are the things that we would be doing in terms of performing data analytics, and we have a team here that can definitely assist related to that. Secondly, collecting all relevant information. Jason and Lease Query will definitely share that in the next section as far as gathering all required information and how you are able to utilize that to then get the entries and the disclosures that you need, and then documenting the procedures taken to ensure completeness. When you go through this statement, you're going to see, okay, I found 500 contracts, but I was able to whittle them down because some were less than 24 months, or some were only serviced and there really wasn't an asset, where I ended up with, okay, I only ended up with 300 leases. What your auditor is going to want to know is, how did you get from the 500 you started with down to the 300 that were inside the scope of Statement 54? So you want to make sure that you're documenting that journey that we're talking about, you all going on through these 4 phases. Phase 3, updating your policies and procedures for leasing transactions, right? You might be adding a new lease account, for example, to your balance sheet. You want to be able to identify the leases, not just now for implementation, but say the ones you enter into in fiscal year 24. How are you going to be capturing all of those on a go-forward basis? We didn't even talk about reassessment or remeasurement of the leases. If you say extend the term, or you have an impaired lease, you're terminating early, how are you going to be able to capture all of those? That's another thing that you're going to need to have within your policies and procedures. Probable, the idea of how are you going to determine if an option to extend it or terminate is probable. That's another thing that's going to want to be drilled into your policies and procedures. You'll want to identify a software solution or other method to perform the calculations necessary for compliance. Being able to give you all of the journal entries, all of the disclosures that you need in order to then book it on your financial statements. In addition, we touched on it a little bit earlier, but just your general ledger accounts, making sure you have all of the accounts that you need to be able to set up all of those debits and credits, and break it out in a sufficient manner within your financial statements. Lastly, and this is the one whenever we engage with people on advisory, they just want to jump to. I just want to book the entries. What can we start typing in some debits and credits? Can we see what that's going to look like? And as hopefully that you're seeing going through this implementation process, is it really is going to be a journey of going through phase 1, going through phase 2, and getting the completeness, building the structure, and then the output. Really, the end of the day success is having the journal entries and the required footnotes and disclosures, and being able to present to all stakeholders, hey, we have an extra $1 billion on our balance sheet of leased assets and or leased liabilities, but this is why, because we had to put all of these things on the balance sheet that maybe weren't there before. And so that's how we think about the 4 phases of implementation. Given how we kind of talk through them, which of the following areas are you most concerned about with implementation of the leasing standard? Is it finding all of your leases, that that completion idea? Is it identifying tools and resources, including software, to implement the standard? Is it updating your policies, procedures, and controls around leases, getting the journal entries and disclosures correct, or no idea? And we'll give you all a minute to answer. The other thing that I want to let you all know is that we do have a Q&A and a chat box that you can submit questions on. Jason and I are also sharing our contact information after at the last slide of the webinar. You can contact us there as well. But we're here for you all to answer any questions that you have related to implementation. All right, so it looks like finding all the leases is the leader, with getting the journal entries and the accounting in second place. Well, no idea second place, which is understandable at this point. But with that, thank you guys so much for your time. And for the next portion of the presentation, I'm going to turn it over to Jason, and he's going to go over gathering required lease information.
Yes, thank you, Danny. And that was an excellent rundown of a lot of the steps that an advisory group like Cherry Bekaert would go through with you all to begin the adoption process. And so for those of you that are most concerned about actually identifying the leases, I think it's exciting to note that once we do identify the full lease population, the next step is actually getting the appropriate details from those contracts. Some of those details are a little bit more judgmental than you might realize. It's not as simple as just taking data from the contract and there's your journal entry. So that's what I'm going to talk through today with you all. What information is actually necessary for you to begin thinking about what journal entries you're going to book. So if we start on the lessee side, and we're going to cover both the lessee and the lessor side, but as far as recognizing account balances on the lessee side, so the SFFAS 54 standard first requires the lessee to recognize a lease liability balance. That's going to be measured at the present value of the lease payments expected to be made throughout the term. Now, we're going to cover in a slide here what lease payments actually consist of. It's not always as simple as just looking at what your initial base rent payment is and multiplying it by the number of payments you owe. There's quite a number of bullets that you'll see underneath the lease payment definition that you'll need to consider depending on what types of payments you might owe in the contract. And then once you recognize that lease liability, when you do adopt SFFAS 54 over time, in order to reduce that lease liability, you will recognize payments made, but the difference between the gross payment you make and what we would consider to be the principal portion of that payment, which is reflected in your liability, you're going to recognize an interest calculation as the variance there. So that interest expense, that's going to be based off of the discount rate that you identify. That discount rate is one of those judgmental data points that you'll need to determine within your contracts. It's not just going to be given to you by the lessor in most cases. So we are going to talk through towards the end of my conversation about how to identify the appropriate discount rate. Now, as far as what should be included as lease payments on the lessee side, so fixed payments being the easy portion of this, any base rent that you are certain to owe within any of your lease contracts, you're going to include those payments within the lease payments calculations. So if you owe, say, $5,000 in base rent, and that is fixed within the contract, there is no change based on any sort of indices or any sort of adjustment based on market rates. That payment, of course, will get included within that initial lease calculation. Now, there are a few variable payments that may get included. So one of those are going to be variable payments that are dependent on an index or a rate. So some contracts might be structured in the sense that you owe a certain dollar amount for rent in year one, but in year two, that payment might increase or potentially decrease based on the adjustment in the consumer price index. Now, the way that you would measure that initially is that you would assume that the consumer price index will remain what that measurement is as of the date that you recognize your initial lease liability. But the point being is that even though your contract might state that your future payments are variable, the amount that you would owe should that consumer price index remain at its current level, that's what you would recognize in your initial calculation for your lease liability. Now, we're also going to include variable payments that are fixed in substance. So just one example of a fixed in substance payment is that you might owe a percentage of, say, sales that are recognized in a particular location. But if there is a minimum amount that is required to be paid by a lessee in a real estate contract, technically that minimum amount, even though the amount you owe in total is variable, the minimum is technically fixed because in substance, you would never owe anything less than that minimum requirement. So any of those situations, and it's not just a percentage of sales, there could be a number of situations that are maybe a little bit more unique to the federal space that you might find yourself owing a percentage of payments, but there is a minimum built in. So that minimum would get included. And then any residual value guarantee amount that is probable of being owed, that is also a judgmental aspect that an organization needs to identify, as any of these contracts that do require a residual value guarantee, there needs to be an identification of what you expect the residual value of the asset to be at the end of the term, and any variance between that and what the guarantee is, you would need to include that payment as a payment on the final day of the contract. That also gets lumped into your present value calculation. So these are just a few of the payments that you'll need to consider as a lessee. As we continue, there are even more of these, and we'll start going through this a little bit quicker. So purchase options, if it is probable that the lessee will exercise the option. When we use the term probable, we would advise around the 90% threshold if we want to utilize percentages here. If you strongly believe you plan to purchase an asset, any price that you would owe to purchase should be included in those expected lease payments, and any termination penalties in the same token. If you feel as if you are going to exercise a termination option as the lessee, or if there is an availability of funds or a cancellation clause in place, both of those would preclude the lessee to including any termination penalty in their calculation. And then the last two items here, any lease incentive receivable from the lessor. So if you are expecting to receive any lease incentives throughout the contract, maybe you've earned those incentives, but you just don't simply recognize them until later on in the term, you would actually net those incentives against the rest of these payments owed, which would actually end up reducing the amount of payments you recognize. But the idea here is that they are included technically in the lease payments category. So we want to make sure that any of those incentives that you receive in the future, they are actually reducing that opening liability balance, because they are a reflection of less money that the lessee would owe. And then the last one, any other payments that are probable of being required. This is more of an open, just blanket capture of if there are any other payments that are technically related to the asset under lease and you are probable of being required to pay them, you should include them within your lease payments as well. And so once you capture the present value obligation and you recognize it as a liability, the corresponding debit will be the ROU leased asset. And so how do we identify the value of that asset? Well, it always starts at the same value as the lease liability, but there are potentially some adjustments you might need to make, especially at the adoption date of SFFAS 54. But even as we go forward past the adoption, you still may need to adjust the asset value. So any prepayments, so a payment that you might make to a landlord or vendor prior to the term length of the lease beginning, those payments are technically, again, referred to as prepayments, but you are essentially recognizing or delaying the recognition of expense until the lease term actually begins. So we want to make sure that you do actually recognize that expense during the term. So when you capitalize the asset, since the asset in full will end up recognized as an expense on the P&L, you increase the value of that ROU asset, which then increases the amount of expense that you'll recognize over the term. Now, you're going to do the opposite with any lease incentives you receive at or before the commencement. So the opposite of what we were just talking about on the previous slide, if you as a lessee receive any lease incentive before the term length actually begins, that is money that is basically reducing the cost that you owe to enter into the lease contract. But because you've already received it, it doesn't technically impact the liability value that you're calculating. We do want to make sure, though, that you reduce the ROU asset value so you do not book an expense for that amount you already received back as an incentive. So it's basically the opposite of what we're doing with the prepayments. And then the last one, any initial direct costs placing the leased asset into service. This is similar in some sense to the prepayment, where these are expenses that, as opposed to us simply expensing in full, as we recognize the actual experience of that expense, we're going to include those as costs required to enter into the lease. So those get amortized over the term length of the lease. So in order to amortize those appropriately, we simply lump that into the right of use leased asset value, and then that evenly gets recognized as an expense over the term length. So those are the three adjusting values you might see as we calculate that initial leased asset. But those are going to be the two balance sheet items that you'll recognize, the leased liability as well as the lease asset. Now, on the lessor side, so if you are owning assets and you lease them out as a lessor, it's going to be relatively similar. So you're going to recognize a lease receivable in the exact same manner as the lessee recognizes a lease liability. Now, the difference is on the opposite side. The corresponding credit that the lessor will recognize is going to be considered unearned revenue, and that value is always recognized at net. So whenever you recognize revenue over time, you'll just simply reduce the unearned revenue liability value. On the asset side, you are recognizing a gross asset, and then you would have the accumulated amortization account that reduces the value of that gross asset to then show you the net asset on the statement of net position. Now, after that initial recognition on the lessor side, you are similarly recognizing interest on the lease receivable based on that discount rate you charge the lessee in the contract. And that will be then captured as interest revenue. So basically the difference between the gross receipt of rent you receive versus the amount that was principaled on your balance sheet as a lease receivable, that amount will get recognized on the income statement as interest revenue. And then the lease receivable, again, similarly to the liability, is going to get measured at the present value of those lease payments expected to be received. But also keep in mind that a lessor should always reduce those lease payments by any provision for uncollectible amounts, if applicable. So if there is any applicable uncollectible here, we just want to make sure that we're adjusting that on the statement of net position, so you're not recognizing a receivable that you don't anticipate actually receiving, of course. Now, the following receipts should be included in the present value calculation. And for this, we are actually talking about the lessor recognition. But again, it's extremely similar to what we talked about on the lessee side: the fixed payments, the variable payments that depend on an index or rate, the variable payments that are fixed in substance, the residual value guarantees that are fixed in substance, and then any lease incentives that are payable to the lessee. Same thing on the opposite side. So as a lessor, if you know you are going to relinquish incentives to the lessee at any point during the term, you would include those as a reduction to what you're capitalizing as a lease receivable. Again, you just want to make sure that what you're capitalizing a lease receivable is reflective of what you expect to owe over the term length, and any amounts, whether it's an uncollectible or whether it is an incentive you expect to provide, those do technically reduce the amount of total compensation you're receiving on the lease. Now, the unearned revenue account is relatively similar to capitalizing the gross ROU asset, but keep in mind the initial direct cost piece is not relevant on the lessor side. So you would use that initial measurement of the lease receivable, but keep in mind, we're just going to be considering any lease payments that you received ahead of time that will decrease the value of that lease receivable. So you would reduce the payments that you've received ahead of time, and then any incentives that you expect will also reduce that amount as well. So just making sure that we recognize the appropriate balances. And actually, I misspoke there. Sorry. The lease payments you receive ahead of time, you're going to increase the value of the unearned revenue. And again, that's because we want to make sure that those payments you receive, you do end up recognizing as revenue throughout the term length, because even though you are not receiving it during the term length, the payment is for the use of that asset during the term. So you'll recognize that as revenue during the period of use. And then any of the incentives, as I mentioned, that decreases the amount of unearned revenue because you won't recognize revenue for any of the dollar amounts that you actually paid back to the lessee as an incentive. And so after that initial recognition, in future periods, you will amortize the unearned revenue balance, what we would call systematically and rationally over the term of the lease, and recognize that as earned revenue. And just a little bit different from the asset side is that this is going to be amortized at net. So you'll always just have a net value of unearned revenue, and then you'll consistently recognize revenue over the term. We would typically see this done on a straight line basis, but if there's reason to believe that there is a more appropriate, systematic, and rational way to recognize revenue, that would technically be an option. Now, the last piece I will cover as far as identifying data points is that discount rate. This is a judgmental aspect of identifying the appropriate criteria for capitalization. So if you are the lessor, obviously you will know what rate you are charging the lessee. So much easier to identify the rate as the lessor. But on the lessee side, typically you won't actually know what that rate is. It's often not stated in the lease, as we mentioned in the second bullet. And also too, the lessee would need to know the fair value of the asset under lease in order to identify the rate being charged. And a lot of times that information just isn't shared between entities. So if you cannot identify that interest rate that is charged or implicitly charged, the estimated incremental borrowing rate is the rate that the FASAB suggests that the lessee uses. And so that is defined as the rate that would be charged for borrowing the lease payment amounts for the lease term. And keep in mind that between the GASB, the FASB for ASC 842, a lot of these definitions for the incremental borrowing rate are actually a little bit different. The rate that 842 uses talks about a collateralized loan. In this situation, it's really just for borrowing the payments under the lease term. And so in general, we note at the bottom here, a federal entity's incremental borrowing rate would be the Department of the Treasury borrowing rate for securities that have a similar maturity to the lease term, unless the entity has its own borrowing authority. So there's just a few things that you'll want to keep in mind. It's not as simple as just, hey, we've got the contract, somebody on our staff can just pull out the rate from that contract. Oftentimes you're going to actually need to identify what that estimated incremental borrowing rate is in order to apply it appropriately. And then also identifying whether your leases are similar in nature enough that you can utilize what we mentioned at the bottom here to potentially lump together a borrowing rate for leases with similar maturity and similar terms. So it's not as straightforward, again, as just finding the data point in the contract, but these are a couple helpful hints here. And then moving forward, past this slide here, lessons learned. So real quick, I will just point out lessons learned from the GASB and FASB implementations. I think the one thing I will point out before bringing Danny back in for some of his lessons is that I would suggest the main thing is getting started on this immediately. If there's anything that I have seen from most of the companies that have adopted 842 over the past few years, whether it's public entities or private, they find leases that they did not realize actually qualified as a lease, because not every leased asset has the word lease at the top of the contract. So there's a lot more due diligence that needs to go into play. Danny went through a lot of the definition of the lease as well as how to identify completeness. And I think that piece just takes way more time than you might realize. So that's the big piece of advice I would give. Danny, I'll bring you back in here. Obviously, you have a lot more experience on the public sector side. What have you seen from your perspective?
Sure. Thanks, Jason. Yeah, I mean, state and local governments, the same thing as 842 in terms of how long it's taking. I believe they did a study and it was like 70 or 80% of governments said that it took longer than they had expected to implement. And so, you know, you starting early is definitely important, and also not going it alone, making sure that it's an organization-wide effort, and that you're utilizing people like Cherry Bekaert or myself and Lease Query to kind of assist you is a big thing. You can probably see that Jason and I are pretty passionate about this stuff. We've been talking about it, 4 or 5 years in some form. And so we could probably go on soapboxes with all of the different stories and things and challenges that we've identified. And maybe we'll do that, in a future webinar. But to make sure that we get you all out on time, let's go ahead and go to our last polling question.
Yep. And so as far as what we're curious about here, so, we've gone through, Danny spent a lot of time talking through what an advisory group like Cherry Bekaert can actually provide from an assistant standpoint. And it's not just, hey, here's the journal entries. There is quite a bit of planning that goes into making sure that you adopt this appropriately. So these are some options. And obviously, if those of you who may need more information, I imagine Ward and Danny would certainly love to provide some more information as to how a firm like Cherry Bekaert could actually help with the adoption here. But we wanted to give you an array of options of, hey, maybe you feel like you've got quite a strong team in place, but you could probably use some assistance as well. We have a co-sourcing option here. But again, I think part of our partnership with Cherry Bekaert also is making sure that you have the appropriate technology in place for long-term compliance. So not just getting those liability and assets on the balance sheet, but also making sure that, say, 2 years down the road, maybe you have to reflect terminations, impairments, modifications to a lot of these contracts. How can you make sure you do that easily without having to constantly ask or go into the market for assistance from that perspective?
All right, great. Thank you, Jason, and thank you all. The other thing, as far as the lessons learned, is in terms of contracting. We Cherry Bekaert and Lease Query have a GSA mass contract as well, which kind of helps eliminate some of the challenges with contracting for this type of assistance. I'll turn it over to Ward to kind of wrap us up.
Terrific. Thank you, Jason and Danny, for your insight and valuable tips. We have a couple minutes left. If there are any other questions, please put them in the chat box. Danny, I do have one question.
Okay.
When you were talking about embedded leases, you used an example around copy machines. That got me thinking, is there a threshold value for what qualifies as PP&E for a lease under the standard? In other words, people think about cars and trucks, but a printer, or what's too small?
So there isn't a threshold as far as value in terms of, does it meet a lease under the contract, right? As long as it meets the definition of property, plant, or equipment. But there is a threshold of materiality when applying the standard, and you need not apply it to immaterial items. So for some organizations, maybe copiers are immaterial, but you'll want to go through and evaluate the leasing transaction. How long is the term? How many copiers are we talking about? In order to help you draw that line to determine what materiality means for your agency or department.
Terrific. Okay, well, that concludes our session today. Thank you for attending, and thank you, Danny and Jason, for your insights and valuable tips. If you have additional questions, please send them to us. The contact information for Danny and Jason are there. One last thing, we value your feedback and ask that you take part in a short survey, which appears when you leave the session. Thank you very much.